Afternoon, everyone. You are welcome to our webinar. You are here for the Financial Series 1 webinar. If you are not in the right place, please know that and feel free to exit. Um, we are, other people are joining very quickly, so we're waiting a few more minutes. Please know that you will get a copy of the slides and a link to the recording within the next couple of days. My name is Sharon Rose, and I'm a SCORE mentor, and I'm with the Cleveland, Ohio chapter. And before we begin, I want to do a brief introduction to SCORE. And thank you, everyone, for saying hello. We love it. People are still rapidly coming in, but I think because we have a webinar today that's very rich with wonderful content, I think I'm going to start our overview right now. So I'm going to share. Okay. Um, as we said, this is SCORE, and we are actually SCORE Cleveland, and our mission is to foster vibrant small business communities. We do that through mentoring and education, and we sincerely believe that every person um, deserves the support they need to thrive as a small business owner. Uh, we actually have the largest network of free volunteer small business mentors in the nation. We have between 9 and 10,000 people, and we're very excited about that because we have areas of expertise from every every industry, every portion of building a business. No matter what the stage of your business is, SCORE is a mentor for you. You could be starting a business. You could be growing your business, want to expand your market share, and you might be exiting a business. And we have experts who are experienced in all of that. We have made an impact throughout the country with our SCORE services, again, mentoring and education. Last year, we started 60,000 new businesses and we created over 143,000 jobs. And 94% of our clients who started those businesses remain operational. It's super easy to get a SCORE mentor and get help from SCORE. All you have to do is go to score.org and put in your zip code, and our regional people will match you up with someone that they think can serve your needs. And that's based upon a very short form that you fill out. And you should actually hear from that person within a couple of days. One of the things that we want you to know is that all of our mentoring services are free and most of our webinars are free. We are supported by Congress through SBA, and that plus donors allow us to remain free. If you are able, please go to score.org and click on the donate button. That will allow us to continue to provide as much as we can. Mentoring services always, most workshops. Thank you very much. And you can take a picture of that or just go to score.org. Thank you. And now I'm going to turn it over to Chris, who will share her screen and introduce herself.
Hello, thank you all for joining us. I had this up and now it's not. Give me one quick second. Here we go. Okay, welcome and thank you for signing up for the Financial Literacy Series 1. So today we're really going to go over general concepts, financial terms and ideas that are going to help you hopefully make more money in your business. So we're going to start with some basic financial vocabulary. It's not super technical. You may be familiar with most of the words, but not all or not many of them. We're going to then move on to figuring out how to calculate your profitability for your business. We're going to look at a couple examples of a manufacturing company and two service businesses. So, whether you manufacture, you wholesale, you retail, you provide services, this is going to give a nice overview of how to calculate profitability. We're going to then use that profitability information to figure out and show you how to calculate what's called your break-even point. We're going to move on then and talk about different types of accounting. We're going to talk about some of the very, very basic financial statements that might be helpful to you, and then how to find and what kind of different financial service providers are out there. So, getting started at the most basic level, we're going to be tracking two things: money coming into your business and money going out of your business. Everything really falls into one of these two categories. So we call money coming into your business your revenue, and we call the money going out your expenses. If we subtract all of your expenses from all of your revenue, that's where your profits are. If you have more expenses than you have revenue, you're going to be losing money. And if you have more revenue than expenses, you'll be making money. So your sales, for the most part, is where your money is coming in. There's also things like uh, you can have income, interest income, if you have a lot of money in your bank account and you generate some interest there. But for the most part, sales are revenue, and all of your costs associated with your business are what all of your expenses are. So again, you have sales, your revenue is the money coming into your business and the money going out. So at the most fundamental level, this is really what you're looking at, these two moving parts. Expenses can be broken down into two main categories. You've got fixed expenses and you've got variable expenses. And each business has both of these, and we're going to talk about how what we need to do with those. The fixed expenses stay the same every single month, regardless of your sales. So that would be something like rent. If you sell a lot or you sell a little, you still have to pay your rent. Your rent does not go up and down depending on sales. Your variable expenses increase as your sales increase. So they vary, they go up, they go down, they might go up and down month to month, week to week, but certainly they are very directly tied to your level of sales. A few examples, if we look at fixed expenses, I already said rent, but something like utilities for your space, an auto loan, insurance for your business, a loan that you might have on equipment, and any salaries that are not related to what you're selling. So this would be cleaning services that you pay cleaning people or a manager or a bookkeeper. Just because your sales go up and down, your bookkeeper, their rate is their rate and they work a certain number of hours. Your variable expenses, like I said, are directly tied to your sales. So if you have any commission salespeople, as they sell more, they're going to make more commissions. If you are a manufacturing company, the more you sell, the more you manufacture, the more raw materials you're going to buy. The bigger your business, the more you sell, the more marketing dollars you're probably going to be selling. If you ship product, You ship more product, that's going to cost more. And any direct labor associated with the products that you're selling. So this would be the people that are actually making a product if you're manufacturing something, or providing a service if you're a service driven business. So we're going to look at a manufacturing company. These are all made up and they are very simplified, but it's in order to point out what these basic building blocks are. So we're going to look at a puzzle manufacturing company called Puzzle Mania. And we're going to start with their fixed expenses. These are some of the basic things that most businesses, if you have a physical location, are going to have in fixed expenses. You got your rent for $3,000, a telephone bill, your insurance, salaries. So again, salaries are not directly related to making the product. This might be like customer service, bookkeeping, maybe some design people designing the puzzles. We've got internet service and utilities. So every month, whether Puzzle Mania sells one puzzle or a million puzzles, their fixed expenses are $9,070. This does not change. Their variable expenses absolutely do change. So when we look at variable expenses, because it's a proportion of the sales, it's going to be expressed instead of as a dollar amount, it's going to be expressed as a percentage. And then we're going to add it up to see what percentage of the sales is going to go to our variable expenses. So in the sample here of Puzzle Mania, their raw materials account for 15% of their sales. Their wages are 20%. Credit card processing fees are 3%. Their shipping is 3%, and marketing is 8%. So their variable expenses are 49%. So I've done this workshop many times, and some of the questions are, how do I figure my fixed and variable expenses are out? It's a great question. I can say following and understanding the difference between fixed and variable is just one element of this. But certainly, if this is something that you're interested in and feel like it's a little bit over your ability at this time, please reach out, get a score mentor, and they can absolutely help you through this. So when you're looking at raw materials here at 15%, that might be an average that is worked out. So think of your business. Think of how consistent your pricing is. If there's a lot of variability, that is not a problem at all. We just add things up and we look at averages over time. You can still calculate both your fixed and variable expenses for any business with any level of variability. It does get more complex as there's more variation, but it's very doable. Okay, moving on to this. So, Puzzle Mania sold 1,500 puzzles at $20 a puzzle in the month of October. So now we can calculate, we know their revenue is 1,500 puzzles times $20 is $30,000. We're now going to figure out profitability on $30,000 of sales. So the first thing we do is multiply 30,000 times 0.49 because our variable expenses are going to eat up 49% of that revenue. That comes out to $14,700. We're also going to subtract our fixed expenses. That's easier because there's no calculation to do. It's just a flat amount. So if we subtract both our variable expenses, 49% of sales, and we subtract our fixed expenses, we're left with profits of $6,230 for the month of October. If we divide 6230 into our sales of 30,000, that tells us we have a 21% profit margin. That is a very, very nice profit margin for a manufacturing company like this. One thing I don't want to miss, as we have, especially with SCORE, we work with a lot of new businesses. One of the things that people don't necessarily think about because they're new, they haven't done it before. If you have profits in your business, you are going to owe taxes on those profits. And a lot of new business owners don't think about this as they're bringing in money and they're paying their bills, trying to keep their head above water. They don't think, well, I also have to pay Uncle Sam of any profits that are left over. Okay, now we are going to talk about what do we do with that profit margin? Why is that an important number? And now what? So there is something called a break-even point for your business. Your break even point is really, really helpful. I cannot stress enough how nice it is to have this number in your head. So, this number is the sales level where your total revenue equals your total expenses. So, you are not making money and you're not losing money. And the way to calculate this break even point is to take all of your fixed costs, which we know we calculated for Puzzle Mania, and we divide by something that's called a contribution margin. Your contribution margin is a pretty easy thing to figure out once you understand your variable expenses. If you don't know your variable expenses, you cannot figure out this contribution margin. And like I said, for a lot of businesses, it's an average of numbers that you can look at when you see what you've paid out in bills over a period of time. So it's not going to necessarily be a clean and easy number. And this is again where a SCORE mentor or a bookkeeper or an accountant can certainly help with this, but it is doable for every single business, no matter what you're selling or service you're providing. So the contribution margin is your price per unit of whatever you're selling minus the variable cost per unit. So once we know that contribution margin, we divide that into our fixed costs, and it's going to tell us the number of units we need to sell or services we need to provide just to break even. The reason that's important is if you are halfway through the month and you know you only have 25% of your break even amount for the month, you know some hustle's got to go on to get now 75% of your revenue in the last half of the month, or you're going to be losing money. So it's a really good guide. Am I on track? Is this going the way I expected? So we're going to go back to Puzzle Mania and we're going to figure out what is their break even point. So we already know their fixed expenses are $9,070. And we also calculated their variable expenses are 49%. So in the case of Puzzle Mania, we'll take $20 and we multiply $20 times 0.49 so that we know what is the variable cost per unit. That comes out to $9.80. So all I did is I put $20 in my calculator times 0.49, boom. That's my variable cost, $9.80. So if I subtract $9.80 from $20, that tells me my contribution margin is $10.20. Now I'm going to take my top number, my fixed cost of 9,070, and I'm going to divide it by $10.20. That's going to give me 889 puzzles. That's what is going to show on your calculator when you divide that number. So 889 puzzles is Puzzle Mania's break even point. That if I express it in dollars, I'm going to multiply 889 puzzles times 20. So I can say I need to sell 889 puzzles, or I could say I need to sell $17,780 to break even. That is Puzzle Mania's break even point. If they sell more than 889 puzzles, they're going to be profitable. And if they sell less, they're going to be losing money that month. So this again is a very, very important number because it sets a goal of what you know you need to do so you're not losing money. And then given your profit margin, you know how profitable you are on every puzzle after 889. You are going to keep 51% of that in your pocket once you meet that break even point. All right, we're going to do the exact same thing, but now instead of a manufacturing company, we're going to look at a service company called Lulu's Beauty Salon. Lulu's has a lot of fixed expenses. She has pretty expensive rent, 4,600. Telephone, I'm not sure why this was 300, but $300 is a high expense for telephone. She's got a lot of insurance, $1,200. She has one manager, that's a fixed expense of 3,750 a month. Her internet IT website is 820 and her utilities, water, electric, etc. is 750. So her fixed expenses every month regardless of sales is the same, $11,420. Her variable expenses are fairly high also because she's on a commission-based business. So her shampoo and conditioner very low, 2%. Hair dye and perm kits are 7%. Her commissions are 45%. Credit card fees 2%. Marketing another 4%. So her variable expenses are 60% of her sales. Lulu's is a very successful, busy salon. She services, on average, 18 clients a day, 6 days a week. There are 4.3 weeks in the month, and her average service is $120. This is again a case where for your expenses and for your cost of service, averages are the way to manage. Yes, there are some things that might be $50. Might be things that are $300, but we will look at the number of services. We will look at the total number of dollars and help you come up with your average service and your average expenses for things. So, all right. So how much is Lulu bringing in on a typical month? She's got 108 services. That's a week. That's 16 or 18 services times 6 days. She's got 4.3 weeks in the month and she's got $120 average service cost. So her revenue for the month is $55,728. Okay, so now we can calculate our profit margin. We're going to take 55,728 and we're going to multiply that times zero point 0.6. That is going to give us 60% of that revenue expense. That comes to $33,437. And we're also going to subtract her fixed expenses, which we don't need to calculate again because it's just a flat number. So if we subtract both her variable and fixed expenses, she's got $10,871 of profit. If we divide that number into her monthly sales for that month was 55,728, that tells us she has a 20% profit margin. So I would say that's a very healthy number. She's doing very well and making a nice amount of money for herself. We're now going to look at Lulu's break even point. Again, this is where she's not making money, she's not losing money, it's just breaking even with all of her expenses. So we know her fixed expenses are $11,420, and we know her variable expenses are 60%. So we are going to do the same calculation, take her unit price, her average service is $120. We're going to multiply that by zero point 0.6 for 60%. That's going to give us a number, $72 is 60% of 120. If we subtract 72 from 120. That tells us that we have a contribution margin of $48. We're going to go back to our top number, 11,420, and we're going to divide that by 48. That is going to tell us that she needs 238 clients per month to break even. So we took 11,420 divided by her contribution margin, which is $48, to get 300 or 238 clients. We can also look at this as dollars. We multiply 238 clients times her average sales of 120 per service, and that's going to give us the dollar amount to break even, which is 28,560. That is her break even point expressed as the number of services or as the number of dollars she needs to bring in. If she does more than 238 clients, she'll be making money. And if she does less, she's going to be losing money. All right, we're going to look at one more example. This is also a service industry, and this is Walter's Window Washing. It's a very, very different setup of fixed and variable expenses than our other two examples, and it also has seasonality and some other things to consider. But let's get started with the basics. So, Walter's expenses are a truck lease for $600. His insurance is 150. He's got a lot of liability because I guess he can break things, fall off ladders. It's a dangerous job, so that's pretty high, $400 a month. He pays his health insurance through his business. That's 1250. He's got a cell phone for 100 and his website and internet is also 100. So his total fixed monthly expenses are $2,600. His variable expenses are really low. His main expense is gas at 10%, cleaner 4%, rags, towels 3%, credit card processing fees 3%, and just a little for marketing 4%. So his variable cost is 24%. On average, Walter can service two clients a day, 4 days a week. I don't know. I think people are from all over the place, but in Cleveland, we are not known for having the best weather. So Walter's business is very dependent on the weather. Some weeks he can work 7 days a week, some weeks he can work 2 days a week. So these are averages that are taken based on how Walter can work. He also cannot work year round doing the window washing, so that has some other implications to think about. But if we look at his revenue on a typical month where he can work, he has two clients a day times 4 days a week times 4.3 weeks in the month, and his average service is $300. So we multiply 8 services a week times 4.3 weeks in the month times $300, and that gives us a number of $10,320 is what he can typically expect to bring in when the weather's decent and he's able to work. If we want to calculate now our variable expense, we take his revenue number, 10,320, and we multiply that by 0.24 for the 24% variable expense. That gives us a number of $2,477 for his variable expenses. And again, we don't need to calculate fixed expenses. That's a flat number. If we subtract both his variable and fixed expenses from his sales, we see he has a profit of $5,243. If we divide that into his sales, he has a really healthy profit margin of 51%. So, one of the things to think about with this type of situation is Come January, we're in a snowstorm. Walter's not washing any windows, but he still has a truck lease to pay. He still has truck insurance. He still has all of his fixed expenses to pay, but he doesn't have the revenue. So we will discuss a little bit later on. Understanding these numbers will help later with something called cash flow that we're going to get into. Um, and how does he manage this healthy profitability, but not running out of money at different points in the year? Okay, so what is Walter's break-even point? We've got his fixed expenses, 2,600, and his variable expense rate of 24%. So we've got $2,600 divided by his contribution margin. So again, to calculate that, we're going to take $300, that's his average cost for a service, times 0.24, which is going to be $72. We subtract 72 from 300 to give us our contribution margin of $228. Now we go back to the top, $2,600, and we divide that by $228. That tells us he needs 12 clients per month to break even with his expenses. If we multiply 12 by his average sales amount of $300, he needs to sell $3,600 to break even or have 12 clients. Now, we know that's not really enough in reality because he has a seasonal business, but at least tells us for his month to month. So we know his break-even point expressed in both dollars and clients. If he brings in more money, he's profiting. And if he has less than 12 clients, he's going to be losing money. So I hope everyone is thinking if you either have a business, what are your fixed and variable expenses? And if you have a business idea that you're trying to put together, all of these things with research can be projected. They might be estimates, but they can be very useful and you can have very educated estimates to move forward with a business idea of calculating these things. So the easiest way to get it is if you already are working with accounting software and you have purchases and revenue and things in there, there are reports to run that will give you a lot of this information. If you are not using specific accounting software, it's not a problem. It will take more time, but all of this can still be calculated. So we need, again, the two sides of the equation are the money in and the money out. So for the money coming in, your sales data, you can look at any kind of bank statements to see all the money coming into your business. If you have any point of sale system that will have information recorded, you might have paper receipts, any of the payment processing, Square, Venmo, Cash App, Zelle, all of those things will be where you get your sales data. Or if you're selling through another system like Shopify, Etsy, Amazon, and so on, you can collect your data there. It'll be a great way. Again, you can look at averages. You want to look at the more time you look at, I think the more accurate you'll be able to calculate averages. And then on the expense side, you're going to look at the debit section of your bank statement, all the money that's gone out in any given month. You can look at a checkbook if you are still writing physical checks or processing that way. You might have paper invoices. You also can ask vendors for an account history. So, as an example, if you sell something, do something, and you have three main vendors, you can call those vendors and ask them. Now it's a nice time because we just finished 2025. You can say, can I get a report of all of my invoices for 2025 as an example? they should pretty quickly and easily be able to email you a report of all of your sales. And then that's really nice if you can look at it for a full year, because then you average it by dividing that vendor into 12 and you know how much you're paying for whatever it is you get from them on a monthly basis. Credit card bills will be show you more detailed expenses. You want to look at any, if you have employees, an employee payroll report has some of your information, and if you have 1099 contract employees. So that takes care of the first part of this is just really how do we calculate profit? How do we then calculate break even? And how are we going to use those numbers more? You're going to see in the second part of this financial literacy series, we're going to put that into play in the second part. But we're now going to start covering how do we get all this information? What are the types of accounting and what are some of the other things to help support you in understanding your numbers and using that information to make strategic business decisions? We don't just collect numbers to collect numbers. We collect numbers to help us be more profitable and make decisions. Should we hire an employee or two? Or when is the right time? Or do we have enough money to finance a new piece of equipment? So all of this comes into play once we start to understand our profitability and break-even points. So back to just general accounting concepts. There are two types of accounting. Most people are familiar with what is referred to as financial accounting. This is a look back situation where you want to see what are your past transactions, what do you have to have ordered in term to pay your taxes on time? Is everything ordered in a way that is helpful, organized, and useful? So part of your financial is setting up what's called a chart of accounts, which is where all of your money gets broken into different categories for your accountant to see, what your expenses are, what your profit is, and all of that is part of financial accounting and reporting. There's another side of accounting that if any of you have accountants or you're looking for accountants, you can ask them, do you do managerial accounting? That's very different. That instead of providing a service of calculating your taxes and doing tax reporting and all of that, managerial accounting is someone, an accountant or someone who is going to help you make financial decisions based on these numbers. So this is more analytical and it is more of a service beyond just paying taxes and keeping track of things that need to be reported. This is really to help make decisions, to have someone who can help with managerial accounting. So, financial accounting produced by accountants, bookkeepers, or accounting software. It provides history for stakeholders. I don't imagine most people have stakeholders, but for anyone who's interested, this is just your kind of raw data numbers. For anyone who's interested, if you do any, you want to get a bank loan or anything associated with your finances, you're going to need these statements and financial accounting to provide banks and that kind of thing. Managerial accounting, again, is a much different experience. You're doing financial modeling, you are forecasting rough periods, dry spells. You can do all sorts of if this, then that, what about this? This is where you generate ideas for your business and see, can I financially swing it? And what would that look like on your balance sheet? Mostly today, we're looking at managerial accounting. How do we use these numbers to make decisions in your business? So, there are some very basic financial statements that you have probably heard of. We're going to cover them just as an overview this week, and we're going to get much more into it in our second part of our series. But today's is really just an overview of what all of these are and how they function. So we have three main financial statements. You've got your profit and loss or income statement. You've got your cash flow and a balance sheet. So these are all to help you prepare your taxes. It helps you if you have any investors that you're talking to about your business. It helps you create financial modeling and projections. And it's a way to get a general grip on how healthy is your business? How well are you doing? So anyone who is really versed in finances can look at these three statements. They don't need to know much about your business, but they can look at these three statements and they can tell you. It's kind of like getting your blood work back from a doctor's visit. You can look at that without ever seeing the person and have a general idea of their health. So let's talk a little bit more. Profit and loss is also referred to as an income statement. It uses data on your revenue and expenses to determine your current profitability. You can then show how profitable your business is likely to be over time. So you can say, if I'm this level of profitable on this amount of sales, and I know this is my break even point and my profit margin, you can use this information to figure out if I had this amount of sales, what would my profits be? If I had this amount of sales, the profit and loss is also used to prepare your taxes. All of your business expenses are tax deductible, which is really nice. You want to maximize your deductions, of course, to mitigate your tax liability. So this is all going to come off of your profit and loss statement. If you do have, you want to expand, you want to take in partners, you want to whatever, get financing, open a second location for something, all of these things are going to want to see, you're going to need a profit and loss statement. It's also a really good way. I always like to do a look back of period over period to see if there's any outliers. So it can help you pinpoint if any certain areas are costing you more than they should. So this is also where your accountant comes in. In any given industry, there are standard expenses, like you're a landscape company, there's an average amount that landscape companies pay for wages, as an example. So your accountant should be able to look at your wages in your landscape company and say, you're a little high, you're a little above average in what you're paying for wages. Maybe you already knew that, and that's a conscious choice because you don't want turnover and you really appreciate your people and it all works out. But it's good to know from your profit and loss statement, you can see how do you compare to other businesses in different categories. Cash flow statements. So this is really, really important, I think, for most businesses making any kind of day-to-day or month-to-month decisions about things. So this is where you see how much money do you really have to work with. It's not your profit, it's how much does your bank account go up and go down. So if we think about Walter's window washing company, he's going to need to predict what his bank account is going to look like in February after he has not been able to bring in any money from window washing. So your cash flow statement is going to track all the money coming in each month and all the money going out each month and what's going to be left in your bank account at the end of each month. So you can use predictive measures, knowing your both fixed and variable expenses, to see how is this going to flush through over the next 3 months, 6 months, however you want to do that. Likewise, if you, let's say, want to buy a piece of expensive equipment and you know to finance it, it's going to cost you $1,500 a month. You plug that into your existing numbers and you can look at cash flow. What do you need to bring in to have the profits to cover that added expense. So, major purchases, any kind of problems that might arise or come up unexpected, it's nice to have a nest egg, a cushion of money to know that you can handle the ups and downs of business. Okay, we are going to talk about service providers. So, I know many business owners don't like the financial management part of things. I totally understand if that's not your thing, and it doesn't need to be in terms of you doing all of the bookkeeping and all the counting. I think it is very important to understand your numbers and to work with people who can help point out when things might be going awry. So, your bookkeeper is going to be your most affordable person. They may or may not have an accounting degree, but they have experience with keeping track of all of the revenue and expenses of your business. So they can organize it for you to a large degree. Most people, I think, they can balance, they can do a bank statement reconciliation each month and make sure everything is recorded properly and in the right categories. They can help you see if there are any unusual expenses or something that stands out in any given month. So that's the cheapest option. The next option is to have an accountant who this is the person who is going to be doing your tax reporting and all of that stuff. They may or may not even have to have specifically an accounting degree. I know accountants that just have a lot of work experience. They may have a business degree, they may have an economics degree or a variety of things, but they certainly are able to do full accounting services. They may or may not do the managerial accounting part, which is where they give advice and they're looking at things strategically. Um, and then the highest level that you can get, and as companies get bigger and bigger, I think it's a good idea to go with a CPA, a certified public accountant. So that is an accountant who has passed a very challenging exam to get this CPA certification. So they are the highest level of accounting professional and provider that you can get. They are licensed by the state. And they, like I said, have to pass a very rigorous test to get to have that certification. So that would be the most expensive of these options. So I also would like to encourage you to think of your finances and your accounting as an ongoing effort. It is not something that you go to the gym and you get in shape. And if you stop going to the gym, you're not going to maintain that strength and fitness that you achieved. So you can get to a fit point and then you need ongoing meetings and overview and involvement to stay on top of things. Because even if you're in a mature business with very predictable and set sales and expenses, things do change. And keeping your eye on the ball in this area, I think is very important to pick up on any changes as early as possible so you can strategize and adjust. So there should be some kind of continuity about your financial projections and then tracking. Am I close? Am I far off? If you are far off of any financial projections that you've made for the future, how do you adjust? Is an important question. And again, that might be just you, that might be you and your accountant. So those things are helpful if you stay on top of. It is something, again, if you have an accountant who is not very hands-on in terms of giving you advice, you might want to think about calling around and trying to find an accountant who can offer that managerial accounting service. They may cost more, and then that's up to you. Is that worth the extra cost because they are going to be providing valuable service that's going to, at the end of the day, put more money in your pocket? Um, if you use accounting software, compare its financial reports to your projections, and you can do this, again, it's a little bit, you're more tight with your projections. They can be very general, they can be very specific. So this again is something to work with a score mentor, who really is experienced in finance and can help decode all of this if it seems mysterious. I think this is kind of what I've been saying. You can collaborate with your accountant, work on your chart of accounts. So again, if anyone is not doing accounting through a software system, your chart of accounts are going to break down your expenses and your revenue into different categories. You want it to be detailed enough to give you good guidance in how to make decisions, but you don't want it to be too detailed where there's so much minutia in the information that you can't see the bigger picture of what's going on. So setting up your chart of accounts and having it be useful to you is something that might need to be adjusted a couple times as you are growing in your business and want to figure out. As an example, with the beauty salon, you can just have sales, or more helpful, break down sales from wash and cut, sales from perms, sales from hair dyes, sales from different categories, and then you can look at the associated costs of each of those categories, and you can see how profitable am I on hair color compared to haircuts. So you can only get that kind of detailed information if you're taking detailed accounting in how your chart of accounts is set up. Regularly reviewing financial statements and reports for trends and anomalies. I think, depending on the business, this is something that you might do monthly with an accountant. This is something you might do quarterly. And again, if you get better and better and better at it, this is something that you might do yourself, even on a weekly basis, just because you get to enjoy and understand the numbers. If you ever have results that are unexpected, sales are way higher, way lower, something is different, you now have data to look through to help you understand why did we have more sales, but I've got no more money in my pocket at the end of the month? That makes no sense. All of that information is in your financial statements. You can look at your data to identify the most profitable product lines or the most profitable customer segments, and you can also diagnose problems from looking at this data. We are near the end. This is, you're going to get a set of the slides, and at the end here is a little glossary of some of the terms that we've gone over, and that is it. So thank you so much for joining us. And Sharon, is there any parting information? I think we may have lost Sharon. Well, thank you so much for everyone who's joined us. I hope this
Sorry,
is
Chris, I
helpful.
was
Oh,
on
that's
mute.
okay. Oh, you're good.
Um, there are questions in the chat. I don't know if you want to take extra time and answer them now, or what you feel the best way might.
So I want to respect, I know people are on their lunch hour, so anyone who has to go, feel free to hop off. I have a few extra minutes, if we want to cover. Sharon, did you get a chance to look at any of the questions? Anything stand
Yeah,
out?
I did. I can give them to you,
Okay, yeah.
share them with you,
Yeah,
Chris.
let's do a
And I
couple.
do want to say thank you to those who need to leave. Chris, you have so many wonderful comments in here, so it sounds like people got an awful lot out of this. So,
Great.
as Chris said, you will be getting the recording and the slides within a few days. Thank you, everyone, for coming. Chris, one of the first questions is, can you explain again the difference between wages and salaries and why one is fixed and one is variable?
Absolutely. So wages are associated with whatever product that you're making. So, Sharon, if you can monitor, I'm not sure where to even click. I guess it's in the Q&A. If there's a specific industry that you're thinking about, let's say you have a ice cream business, everyone that's related to scooping, selling, and serving the ice cream is going to be direct labor. So the more ice cream you sell, the more people you need to scoop and serve your ice cream. The bookkeeper is salaried. Cleaning people that come in, that's just going to be a flat amount. So you want to look at things and ask yourself, if I sell more, does this number change? If it does, it's probably direct labor and a variable expense. If the number doesn't change, it probably is not. So a manager at a hair salon, if the salon has five service people or 20 service people, you pay the manager to manage the salon, regardless of the volume of what's going on. So they are a fixed expense, not variable. So I hope that helps.
Any questions about that from anyone? Let's see. I think you're all muted. So if you have a question, just put it into the chat. I'm still watching that. Um, one of the questions here, and it's not one, it's a couple of them about how do you figure out price per unit when you don't know what all the costs will be, like accounting, legal, or if the unit prices vary.
So it's tough, but it's 100% doable for every single company, and it is going to be based on averages. So it's sometimes very hard when, you might have 20 different price points for something. How do you know what your average is? So you can look at 1 month over 1 month over 1 month and see how consistent pricing is. So, whatever it is that you're selling, you're going to want to see how many sales did I make and what was the total revenue. You divide your total revenue into the number of sales, and that'll give you an average. But I wouldn't even leave it that simple. I would do that month over month. Then, if you have enough data because you've been in business long enough, I would do it as a quarter. And I might even do it and look at it as a year. And then I would ask myself, do I have the same average sales amount all times of the year? How does my average sales this year compared to my average sales last year? Is there any variation there? So once you start collecting these numbers, you can play with them. For me, it's playing because I just love finances so much. I think it's so helpful. I look at it from many, many different angles. So you can put it together, take it apart, look at it from this angle, look at it from that angle. And like I said, if this seems overwhelming, having a good score mentor who is good with finances can break all of this down with you, hopefully in a way that makes sense for your business, because every business has its own, kind of confusing parts. So it's not as simple as this. I sell one product and this is the cost and I know all of my expenses, but you can use your history to figure all of those numbers out.
Good. There's one, can you pay health insurance through your business? Someone wanted to know that.
So
Yeah.
Yes, so I think that different types of businesses have different allowances and different options. So you start by default, if you don't set anything up, you're just a sole proprietor. It means you make money, you bring money in, but you're not, there's no protections. If you're an LLC, you have protections, but you don't necessarily have all the options of writing things off. I think, and this is something to talk to your accountant, based on how your business is set up, can you write certain things off as business expenses? You may be able to pay it through your business, but that doesn't mean that it is tax deductible. So I know for sure that if you incorporate, you have lots of tax incentives associated with incorporating versus being an LLC. And the general rule of thumb, and this is not advice, if you have employees and more benefits, you pretty much want to think about having an incorporating. And if it's just you, most stuff can probably be done well through an LLC. But that's a great question, and I would absolutely talk to your accountant about that.
Great. And Chris, we'll take one more question here, and it's how do you know when to use free software like Wave apps or some of the others that you suggested, and do it yourself, QuickBooks, uh, or get an accountant? Do you have any thoughts on that?
Yeah, so I think really everyone needs an accountant at least for doing the tax preparation part. And if you are comfortable using free versions, I think number one, there's limitations on reporting. So that, mm, I think is going to be tough. Many of these things can be done on paper. They don't have to be done through an accounting software system. If you do use a free software system, just know it's going to have its limits. And the more you understand about your finances, you can customize even within those free versions. You can create your own chart of accounts, but it's much harder than working with existing systems. Also, on chart of accounts, anyone who's interested, you can go to ChatGPT or even Google Gemini and say, can you show me a typical chart of accounts for whatever your industry is? And then you can see what you're currently using and what your current chart of accounts is, if you have that, and see does that meet the standard in your given industry. So chart of accounts is set up differently for different companies depending on your industry. Um,
Wonderful.
and what is the title for the second part? I think it's just Financial Literacy Series Part Two. Sharon, is that
Yeah,
correct?
it is, and it's on Thursday, the 22nd. I put that in the chat someplace. And if you did not, it's Thursday, the 22nd at the same time at noon. And if you are interested in attending that and did not receive SCORE's regular email address, you can go to score.org/Cleveland, and under the webinars and events, just click upcoming events and scroll down the page until you see the events from January, late in January, and you'll see it right there. And you can click on it to register.
Perfect.
Okay. Everyone, thank you so much. If you have questions that you were not that were not answered, you can, as Chris and I have mentioned, you can go to score.org and request a mentor to help you with those. And again, it is all free. So thank you and have a wonderful day. And Chris, thank you so much.
Of course. Have a great day. Bye.
Okay. Bye-bye.